Welcome, Maverick traders, to another trade skill development course. This is going to be on the horizontal spreads, also referred to as the calendar spread, continuing the non-directionals. This is a really cool strategy you guys have just learned. So let's go find one of these and put it onto the trade bench. All right, guys, the first thing we'll do, as always, is jump onto our training center. Let's go find the non-directionals. This is going to be horizontal spreads, module 2. And let's take a look at our PDFs. So we can build ourselves some rules. All right, guys. So horizontal spread we're looking for. This is the call spread. Now, guys, I'm not reteaching the class. The call spread and the put spread are interchangeable. The only difference would be is if you want to place the strike prices slightly above the current stock price or slightly below the current stock price based on your bias. Horizontal calls are designed to be as close to sideways as possible, but let's say that you've got a stock that's trading at 25.10, 25.15, let's say, but the only strike price choices you have are 25 or 30 or 22.5. Well, obviously, if you want to use the puts, you're going to be doing something that is in the money by 10 or 15 cents. However, if you do the calls, it'll be out of the money. So that's kind of the variance between using the call and the put when it comes to however I use it, is if it's slightly above it or slightly below it. However, you might also have a slight bias. Horizontal spreads are supposed to be a gray area. Understand that, folks. You're learning a lot of gray area trades. The vertical credit spread, and now to the sideways, the horizontal stuff. There's also a couple more coming up, the diagonals and the butterflies, that are also a gray area. It doesn't need to be the exact price, but it can be slightly above or slightly below it, and it will still make money. So keep that in mind. No difference between the call and the put spread when it comes to basically anything, except if it's slightly below the strike price or slightly above it. Now that I've taught that, you guys will know that I'm just going to do a call example because the put is the exact same. So let's write down these rules in our trade bench. I'm going to go ahead and just drag this over, and I've probably already written them down, but let's take a look to see if I haven't. So the first thing I need to go is to my configuration. I need to go to my strategies and make sure that we do have a horizontal call spread or a horizontal put spread. And let's see. Did I call them horizontals or did I call them calendar spreads, folks? It is interchangeable. So the first one, I do have a call calendar spread. You can see down in here I actually do have the put calendar spread as well. I differentiated between the two because it's kind of nice that when you go to do organize and pull back your results to say, hey, how well did I do using the put calendar spread versus the call calendar spread? Just a different way to organize it. So keep that in mind. If you want to pull them both up just to see all calendar spreads, just select both on your when you go to pull up the information. So let's go to the call calendar spread, and I'm going to hit edit here because I do believe that I have already built, calendar spreads. Now what's really cool, I'm going to show you this list. Let me go over to checklists. Right? By now you guys should know how to build these and add them to specific strategies. So I noticed I just have one checklist that says calendar spreads, and let's go ahead and hit edit on this so you can see it. Buy one long strike plus 1 month at expiration, no earnings or news within the time frame, still a short strike price matching the time frame and target, and the stock beta a little bit less than 1.5. The stock beta I threw in there. I don't really use it personally. It doesn't matter to me as long as I see consolidation in the chart. I don't really care too much if it's usually an aggressive stock or not. But notice how I replace calls and puts with strike. That way I can just have one checklist for both. So the checklist is built. The strategy is built. The next thing we need to do is go out and find something that fits it. So let's jump out to a stock that I did find. Now I found this on the FinViz. And what I liked was AT&T. AT&T showing a little bit of resistance about the 32.5 level. So I'm thinking that this is going to consolidate here for maybe about 10 days, and then it'll shoot up within that month's time frame, pushing above 33, maybe 33.5 as far as a breakout. So I took that, and then we jump over to our Thinkorswim, as always, right, guys? Okay. So what I'm looking for is it's going to consolidate here about the 32.5 mark over the next 8-10 days, and then it's going to break out higher, and I'd like to be long a call at that point to see if it can continue further. So remember, I need to buy at least a month out, right around a month out, to see how, so I can carry this forward once that front month expires. So let's take a look at the analyzed position. Let's build this horizontal spread real quick. Oh, great. We've got all sorts of different choices and strike prices. Let's see what 11 days out is, because I think it's going to stay sideways. I said 8 to 10 days. Let's go the 11. It's okay if I'm wrong. Right, guys? This is gray area. It doesn't have to be perfect. And let's take a look at the 32.5, which is at the money. Now, the stock is currently at 32.60. So the 32.5 is pretty much in and at that money. Now, what I'm going to do is I'm going to put this slightly higher, just by 50 cents, just so I can avoid this for a little bit while it's playing. And it's only going to give me about 20 cents here. That's okay. That's okay, because I know that if I go down and buy the 33, let's say down in July or maybe July week 1, or week 3, or, sorry, that would be week 4. You know what? Let's just do regular July. In this case, it's 2 weeks away, which is 25 days, almost a month. 32 to be more specific, but let's take a look at it. You know what? Maybe I'll just skip out to the July week 4, giving me a full 32 days. Oh, wow. That's going to give me 50% return based on cost. How do I know that? You guys have done this class. 20 cents selling, buying it for 40 cents. That's 50% on the return when it comes to the sold month, or the sold strike. Definitely going to do this one. So I'm going to hit sell on this. Come down here, hit control. I'm going to go down and buy this bad boy here. And I've got myself a calendar spread. I'm going to knock this down to 1 just because it's much easier to evaluate. Take a look at the risk profile. Okay. Ooh, it's 1-to-1 on the risk-reward ratio, which is what's to be expected. Now, risking about 23 cents because that's what's going to be the net debit. But at the high here, I can make probably about 24 cents. So it's 1-to-1. That's what you can expect on the horizontal. The idea of the horizontal spread, folks, is you have a landing area, which is right around the strike price is selected plus minus your risk and credit. So it's a pretty good area. Now, the cool thing is if this can stay at 32.5 to 33 in the next 11 days, right? Because we're doing that the June 28th or week 1, July. Then we're golden, because what will happen is we are going to be left with a long call if it gets up to 33. That's at the money, and that thing only cost us 23 cents. That's the idea behind the pattern. So I like it. I think it's wonderful. The next thing I need to do is kind of figure out my risk graphs or my cost basis. So if this is going to cost me 23 cents, now this is what's the tough part about putting it into the trade bench. Follow along here, guys. If I'm going to risk $250 per trade, and this is 23 cents, I can literally buy 10 contracts and be risking $230. Now, guys, you can do less than 10. You could do 9 because you want to, maybe commissions high, so on and so forth. But just for argument's sake here, I'm just going to do 10 contracts. So keep this in mind so far as we go back to put this into trade bench. Because, once again, guys, I'll say it again, trade bench is not conducive to options. So we have to get a little bit creative when it comes to entering something that has a 2-stage expiration cycle, right? We're going to have an expiration cycle in 11 days and an expiration cycle in 32 days. Okay? We have to trick the system to where we can get in there and log what happens. So let's go to my trade plan. Let's go ahead and use an existing full trading plan. That way we can play with a checklist. So let's do a new trading plan that we're building for AT&T. Now, remember, guys, we don't just put this in and hit enter because it'll just give us the stock. We need to put in the full combo. This is a, let me see if I can pull these numbers up, folks. Sorry, I'm going to steal this away from you so I can actually read what I'm trying to do here. This is AT&T July 5th / July 26, 2019, 33 call calendar spread. There we go. Now I have it. Now here's my multiplier. I usually like to do this by 100 because it actually helps the commissions since I'm using thinkorswim commissions. We'll keep that in mind. Let's go ahead and select the call calendar. Here comes the checklist. Everything checks because we did that before. Okay. Now, how do we get our values? Very simple. We use the risk graph. So I use thinkorswim. My planned entry price is 23 cents. My planned target price, folks. Now remember how we get our target price. I'm going to bring this back over. Our planned target price is going to be up in this area, right? So if we stand to make $25.34, now I'm looking over here again, $25, and I got up to 34 cents there. Let's call it $25 just to make things easy, okay? I need to add 25 to 23. 25 cents to 23 cents for a total of, right, because this is just gain above and beyond our current cost. Keep that in mind. So I'm going to go 0.23 plus 0.25 equals 48. So we're expected to make 48 cents. Go ahead and put that in there. 0.48. And our planned stop loss is 0.01, right? We are just position sizing for max gain, max loss. Now, when we go over here, your risk amounts will be put in automatically based on what you used to set up your broker prices, once again. But our order quantity is going to be different because you and I are choosing 10 contracts. And let's scroll down here, and it says $234 is our risk. Then we have some commissions in here. Commissions are going to be upwards of the $13.90, added $13.90 to that $234. That's well within our parameters. Okay, we're well within that parameter. Now here's where it gets a little bit difficult, and this is on the position size. Now, folks, we are in, and this is going to be the same for our next class, which is the diagonal spreads. We are in a multi-tiered expiration cycle. With the trade bench, we can put in a trade, we can add to the trade, and we can exit the trade. However, we can't adjust the trade. And I found that a little bit perplexing because we can't make adjustments without taking something off or putting something on. Meaning, in order to adjust a trade, we have to remove a contract or add a contract. So what happens if we have this 33 calendar spread that gets to the first week of July, expires, and we want to make a note that that front month expired for the max credit? We can't go in and make that note without taking something off. So how I've gotten around this, folks, and once again, you don't have to do this. You can actually just write a note on the side and close the whole trade when you close the whole trade. I'm just going to go right over here, and I'm just going to add one more contract. Now, it does change the risk-reward parameters, so on and so forth, during the trade, but that doesn't matter. Remember, this is a journaling software. All this does is it gives me one contract to log in and allow me to make notes on what expired. Folks, let's say that it closed above the 33 mark to where we actually had to buy back that contract. I can actually use this one to go in there and exit one for a small loss, right? Because if we have to buy back, we have to pay for it. So I could add that to the expense, meaning that we can minus it from whatever the cost of 23 cents was. So it just gives us flexibility. So I'm going to do it this way. You don't have to do this, guys. You can simply just leave it as 10 and write down notes physically, and then when you're completely finished, we can deal with it later on, meaning you could just put it all in once the order's complete. So I'll do it this way, for example. Maybe during the diagonal spread, next class, I'll do it the other way. Probably not. I'll do both. Okay, so let's do our labels here. It's a 0. It's a +1 trade. It's definitely, I don't know if it's a ascending triangle, but it's definitely it's a double top. It is basic. Maybe it's consolidating. Is there consolidation in there? Yeah, it's consolidating. Whatever you want to put in there. Let's do this. Let's get rid of these guys here. I like, you know me, I like to do this. Right click, copy, go back to trade bench, Control V, gets it back, and then hit arrow down or return, and then you can put down, target at 33 before July 5th. Just made that up. All right. I'm not sure exactly what the date is, but whatever you need on there, so on and so forth. So let's go ahead and submit this. Now we have a setup trading plan. Okay, we've got our setup trading plan. And then the next thing we do is once this plan comes to fruition, and what's really cool is we could set up 2 or 3 of these. Which one triggers first, it doesn't matter. And what's really cool is, let's say that I've got a couple of trading plans up here. Here's one from a previous class that we did. And it's like, okay, well, I'm going to go with the AT&T versus Kohl's. Simple delete right there. Just get rid of the trading plan that you're not going to use. I found that to keep things nice and organized and nice and tight. So let's say that AT&T decides to trigger. So I just go ahead and hit add order, proceed to the order, and let's say we got everything that we wanted. Order quantity, I got the 11 contracts that I wanted to. The fill price was 23 cents, and everything looks pretty good. Add the notes here. I'm not going to do this now, meaning I can exit, or you could even make this note. I added one contract for a placeholder, because that's all this is, to note management Management. That's a tough one to spell, huh? And adjustments. Cool. So now I know that, hey, I've already added an extra contract. So it's like, why did I do 11 versus 10? It's simply just a placeholder to do that. So I go ahead and hit submit, and I've got the trade live. So I'm going to go through a hypothetical with you just in case this does happen. So I'm going to scroll down to T. Now, a couple things. Let's go back to our risk graph. So let's say a few days go by and the stock ends up closing at, the first scenario. Let's say that it ends up closing just below 33. Just below 33. Okay, like say 32.89. So let's jump over here. And I'm going to hit add exit order. And what I would do is I'd say quantity 1. My fill price was exactly the same. So what I'm doing here, guys, is I'm putting in this is a break-even trade. Now, it is going to generate another commission, but then again, folks, when an option expires worthless, it doesn't generate a commission. So maybe I can see if you could try to wipe this out, but so you will generate another commission. So take that in mind. So it's not going to be specific. Now, if you don't want to generate the other commission, then you do it the other way. Don't add the extra contract as a placeholder. Don't worry about it. Just put in the 10, write down on a post-it note or make a note somewhere else that, hey, I'm going to close this whole thing at the end. That way you can save the commission. However, the commission might be nice if you have to buy this back. So the first scenario is it closes at 32.89, right? And it's no big deal. However, let's say in this situation, let's say it closed at 33 20. So it closed at 33.20. But you wanted to carry over the week 4 option. So at $33.20, you know you're going to have to pay 20 cents to close the 33. So what I thought was pretty cool about this is what's nice about having a placeholder is I can say, well, it's close at 33.10. It cost me an extra 10 cents. Did I say 20? Well, whatever. Let's say it's 33.10. Sorry, folks, if I'm changing the prices on it. But all I'm going to do is take the 10 cents it cost me to close that and minus it from my cost basis. So I'm going to take 10 cents, minus it from 23, and it'll show that 10 cent loss. So I had to buy it back. Then the commissions are correct. And I'll put a note. Had to buy back before expiration for 10 cents. And then you could put still holding the longer term. See, now what you can do is it takes care of it. So now we've got an updated active trade that says, okay, I had to buy it back. Let's scroll down to it here. You'll see in a sec. I had to buy it back for 10 cents. Now you have 10 left, right, versus 11. It knocked down, it took into consideration loss and added a commission. So let's say we get to the end of the trade, and I'm going to close the whole thing. Let's say that AT&T worked out really good, and you close it at $35. So let's find out what it would be up there. Well, I'm just going to make it up because the risk graph will have changed because it's a long call. So $35. That's let's say we sold it for $2. So we go, okay, it moved up great. I'm going to do my remaining 10 contracts. My fill price was $2 even, right, which is well above 23 cents. Stock hit price target of $35. There you go. Took profits. Whatever you want to put, whatever happened. Go ahead and hit submit. And you can see that we made a really good job on the remaining difference. So the problems and the pitfalls with this is with two-stage exits, you need 2 stages of notes. Once again, you can see I could have actually in the notes as well. I didn't, but in anywhere here I could have taken another snapshot of the chart. There was no reason to because this is hypothetical. Here is our trade plan summary. This is how we set it up. This is the actual trade that we made. Here's our, and here's how we organized it and the totals. So the hard part is 2-stage exits. If you want to get into the trade as something expires, or let's say you roll it. Let's say you decide to buy one back and sell another one. Making those notes is actually you're going to have to add that extra quote unquote, that extra contract, right? That extra placeholder. So in this case, I did 10 contracts. We'd have to add the 11th. So you could go back in there and say, hey, I rolled the 33 up to 35. And then you could put the net difference of how that costs. Maybe you had to buy in this example, we had to buy one back for 10 cents, and then maybe you sold another one for 50 cents, which would net you a credit of 40 cents. So you could make note of that credit, so on and so forth. So again, it's not perfect. There's a couple ways to do this. Just find the best way that suits you. A lot of traders, once again, and this is just a journaling system, will go through the whole process, the whole trade, write down where they adjusted, so on and so forth, and when it's finished, they will come into here and do it as one trade, just a journal. That is probably going to be the most accurate, because whether you rolled it up to bring in a credit, reduced your cost basis, and then it hit a target that you put a stop on, then it went higher, then you could just take the end result. What was the overall adjustment when it came to your cost basis, and what was and what was your overall result when it came to your execution when you closed the trade, your net overall gain. That's a little bit easier that way. It's a little bit cleaner. But if you really want to follow it as it goes along, you got to get creative. All right, folks, thanks for joining me, and we'll see you on our next class. Bye, everybody.